this is interesting. Wealthfront has this cool little interactive chart which shows the historical performance of their classic portfolio. And we can toggle it between 3-month, 6-month, 1 year, 3 year, and 5 year at the longest. And down here, we can adjust to see the portfolio for various risk levels. Now, the risk level is a metric internally that Wealthfront assigns you when you sign up based on a questionnaire. And this is common practice for Wealthfront, basically any robo-advisor or basically any traditional financial advisor for that matter. When you sign up, they ask you some questions to establish your risk tolerance, and based on your time horizon and risk tolerance, they assign you an asset allocation. Right? So here we can see Wealthfront's risk level 10 out of 10, which is basically 100% equities. And I say basically because they do have 2% allocated to muni bonds, but the way I see it, that is practically immaterial. Muni bonds really are not contributing much to the risk or return of this portfolio. So I'm going to compare this to a 100% equity portfolio and refer to this as 100% equities. Although technically, do note, to be technically correct, there is 2% allocated to muni bonds. Now, what's cool is here as we slide the risk level down and more gets allocated to bonds, less gets allocated to stocks. On this chart, we can see the volatility decreasing along with the total return decreasing. So let me slide it down, and there we go. We can see the volatility is decreasing. The total return is decreasing as we're allocating more and more to bonds and subsequently less to equities. Down here to risk level of 0.5, Wealthfront allocates you about 70% to bonds and 30% to equities. So if we come through, we can see 18 to US equities, 7% to dividend growth, which is also going to be US, foreign developed 4%, and then emerging markets 2%. So what is that? 31% to equities, 69% to bonds, whereas up here 10 out of 10, you're technically 98% equities, 2% bonds, but we're just going to refer to that as 100% equities, right? One thing I have to point out is Wealthfront keeps their portfolios pretty simple. At 100% equities, you've got exposure to 5 asset classes, 5 funds. Down here, as you get more into bonds, you get more exposure to other asset classes. So you get exposure to, I think, 7 asset classes right here. So it's still a pretty simple portfolio. Now, behind this asset allocation, Wealthfront has a white paper. And again, this is common practice for pretty much every robo-advisor and every financial advisory firm you go to out there. They're going to have they're going to have a white paper, explaining their investment methodology and why you get allocated what you do, like why the equity portion of your portfolio is 45% US stocks and why 20% is foreign developed, right? And all of these white papers from all the robo-advisors and all these big firms are damn near the same. Like you're going to see the same terminology when you look at them. You're going to see modern portfolio in there. You will probably see mean variance optimization. You'll see CAP-M model. Somewhere in here you'll find Black-Litterman model, right? All of these models are basically the same for all of these advisory firms to assign or to generate their asset allocations and justify why you're 45% US equities and 20% foreign developed stocks. So what I'm saying is they all use the same math to generate slightly different portfolios that they try to justify are better than others. Right, so what I wanted to do here was compare Wealthfront's historical performance to a simple market cap weighted index fund globally. And we're going to look at 100% US equities because we can compare that to Vanguard's Total World Stock ETF VT, which is market cap weighted, right? So for that ETF, they don't use any methodology to determine, what is getting allocated between US stocks and foreign developed stocks in emerging market. They simply hold everything at market cap weighting. And the expense ratio on the fund is a mere 8 basis points or 0.08%. So it's a very low fee, all-in-one fund that gets you global market exposure weighted by market cap. Now, if we look at VT and the portfolio composition of VT, Vanguard's Total World Stock ETF, what we'll see when it loads is that it's allocating 58.96% to US equity, 40.2% to non-US equity. And this is simply based on the market cap split of US equity and non-US equity. If we go back to Wealthfront's portfolio, what are they doing? 45% to US here. Oh, then they got dividend growth at 14%. So that's putting you pretty damn close to what the total world split is here as represented by VT ETF. So how is the historical performance done? How would a 100% equities portfolio by Wealthfront compare to 100% total world stock ETF VT, the all-in-one fund with a low expense ratio? Well, we can see over the last 5 years, Wealthfront's 100% equity portfolio has returned 69%. And then we can compare that to VT. We'll pull it up on a chart here, which is going to show the total cumulative return. We'll click this little 5-year button here. There we go. So we can look at it over the last 5 years. And we see over the last 5 years, VT has had a return of 79.11%. So on a total return basis, this simple all-in-one Vanguard ETF has outperformed the classic portfolio by Wealthfront at 100% equities by 10% on a total return basis. I think that's pretty damn interesting that such a simple market cap weighted fund without any of the white paper methodology has actually outperformed Wealthfront's performance, has actually outperformed the Wealthfront classic portfolio there. So what's the takeaway? What's my point here? Well, first of all, simple is generally better when it comes to investing. And number two, all of the advanced documentation and everything, this stuff is all hindsight, and it doesn't necessarily mean, and usually doesn't mean, any accuracy or outperformance going forward. It is very, very difficult to beat simple market cap weighting, as you can see here in this example of Wealthfront's portfolio performance versus VT, the all-in-one market cap weighted ETF. Now, am I saying robo-advisors are bad or that you shouldn't use them? No, I'm not saying that at all. I think robo-advisors are great options if you want to have, a semi-managed portfolio at a low fee. So if you're investing in VT, you're kind of doing everything yourself and relying on your own expertise, your own knowledge, etc. Whereas Wealthfront brings some expertise and knowledge to the table, in terms of risk profile and tax loss harvesting. They also do some of that, so that can compensate for their fee and bring you some additional return there. They also bring you a portfolio line of credit, which they make easier to access than other brokers do. And I think overall it's just a better option than just kind of going at it blind for most folks. They also bring in automatic investing. That too is a huge component of robo-advisors, and just constantly investing a little bit each week or a little bit each month, whatever your budget allows for. So I think robo-advisors still bring a lot to the table. But what I wanted to point out is that generally, as a general rule of thumb, all of the advanced modeling or portfolio methodology here isn't going to beat simple market cap weighting. Statistically, you are more likely to outperform with simple market cap weighting than you are methodology for asset allocation. So yeah, that's a wrap on that. That is how the Wealthfront historical performance stacks up against one single fund, that single fund being Vanguard's Total World Stock ETF. I'm signing off on this one, guys.